Hey, everybody, can you hear me on Zoom? Okay.
Yeah.
Okay. I had created a new invite this morning. That's what the problem was, and I was on that and nobody else was. So I'll go ahead and delete that. All right. So on this will be the last optional day to Zoom in on Monday. The face-to-face classes start for everybody. So expect to see you all back in the class face-to-face. If you have extenuating circumstances, send me an email if you have had to leave the area, and we'll work something out. But everyone should be back on Monday face-to-face. And one of the students, Brett, was just telling me that the parking lot by Powell is closed. So hopefully they'll work that out. So you'll have enough parking before Monday. So anyway, expect to see you all back in class on Monday. All right, so today we're going to go over chapter 3, which is on taxes. And we're in the chapter 2, just to review, the chapter 2 homework is due on Monday, the 27th. So make sure you turn that in class or through Moodle on the 27th. And then the 29th, chapter 3 will be due. So we're easing back in here. Okay, so let me share the screen, and I'll pull up some things that we're going to be talking about today. Okay, so before we get started with chapter 3, does anybody have a current event
Me,
that they brought in today?
Professor.
Anybody on Zoom?
Me,
Who's that, Alexia?
Alexia. Yes.
Okay, go ahead, Alexia.
Hold on. Can you hear me?
Barely. I'm trying to change my volume. I don't know why it's not working. Go ahead, I can hear you.
Okay, so basically I did my article, current event on how the stock charts warn of chance for bigger market decline as Fed decision looms. So
Okay.
basically, after a failed rebound analysis, say more trouble may be looming for stocks, especially as the market heads into the uncertainty of the Federal Reserve statement coming Wednesday afternoon. The stock started Tuesday higher, a day after the worst sell off since May, but by the end of the day, the Dow and S&P 500 were lower, and the S&P in fact closed just slightly lower
Okay.
at 4,354 and remains significantly below its 50-day moving average, and now is at 4,435. And basically, it was the first time this year the index held below that the key momentum indicator for more than one day. And
Okay.
if the 50-day average of the last, the 50-day is the average of the last 50 closing prices. And if the index or a stock falls below it, it could still signal steeper declines.
Okay. So I know you guys couldn't hear in class, but Alexia's article is on, can you guys hear me on Zoom all right? Alexia?
Yeah.
Okay. So Alexia's article is about this looming situation on September 30th. So the House if they don't lift the budget ceiling, the debt ceiling rather, the government's going to run out of money. It won't be able to operate. And so this happens periodically, and they usually just kick the can down the road. That it always causes some consternation in the markets leading up to it. So that's, to me, that's an investment opportunity. So what happened was the House passed the House passed a bill to lift the ceiling. It still has to go into the Senate, and they're working on that. So we'll see what happens, but it always works out. So my advice to you, if you have any money on the sidelines or have a little bit of money you want to invest, maybe you have a Robinhood account, anytime the market goes down, buy more stock, because it went down on Monday as Alexia was saying, pretty good decline on Monday, like 2% pretty much across the board. And you know what I did, I had a little bit of money to invest, so I just invested a third just to be on the safe side, because it could continue to go down. So I just invested a third of the money that I had, and now, of course, now it's gone up. So it's just anytime we have these dips, it's good to be investing. And so the market has been kind of flat all through September, but that's typical in September. But and I'm kind of bullish on the market. I would recommend investing on any dips, because typically the market has a pretty good run to the end of the year. Now, you never, of course, you can't predict the future, but starting in October, we've got the fourth quarter earnings reports coming. And so these earnings seasons, the stock market almost always goes up during earnings season. And so, like I said, I would be buying on any dips. And I have a relative who about a month ago went totally to cash, which I don't recommend, but the person actually did time it right, because the market really hasn't done anything. And but see, this is the problem. If you go to cash, even if you time it right, then the next problem is, when do I get in? And so now the person's faced with a situation. He didn't get in on Monday because he thought the correction was going to start, and now he's still out. So even when you time it right and go to cash, then the problem becomes, well, when do you get in? And you're trying to time it when you buy back. So for you guys, and at your age especially, I wouldn't ever recommend just selling out of everything. But if you think that the market's going to correct, maybe take some profits and have some cash on the sidelines. So anyway, that's a good article, Alexia, that we haven't heard about that in a while, the government running out of money, but it does happen from time to time, and they just increase the debt ceiling. Okay, well, let's anybody else? Okay, I'm not going to ask for volunteers till we all get back to class, but if you have some time before Monday and you want to look at an article and bring it in and turn it in, share it with the class, that's fine. Go ahead and do that on Monday. Okay, so we're going to be talking about taxes here. So when I saw this slide, I didn't even get like a fourth of the way through it. And I said, and I have to talk about this slide, not because of the subject matter, but I have to talk about this slide because this is something you should never do in a presentation. I mean, I'm sure you guys all know that, but I mean, really, they've written a book here. It's way too much to read. So some of these publishers really aren't up to they don't have very good, how should I say, PowerPoint etiquette with putting all this information in here. So anyway, we're skipping that slide. Okay, let's look at this one. This factor fantasies. These are some pretty good questions here. So let's take a look at this. Let me see if I can, hang on, let me fix this and make it bigger. Okay, so first question. Every individual or married couple is required to file a federal tax return regardless of the amount of income earned. All right, so is that true or false? Is everyone required to file a tax return regardless of how much money you make? No, Wendy? What are the? I don't remember what the part is. 25 something. It's whatever the deduction is. All right, so and we're gonna, I have an updated, I posted an updated tax sheet I'm going to pull up in a minute. But it's 25,000 for married, it's 12 something for individuals, the standard deduction. So that means that you can deduct, if you're single, you can deduct up to over $12,000. I think it's 12.4 or something. We'll see in a minute the exact number. So if you didn't make $12,000, you don't have to file technically. But I would recommend filing because you never know what can happen. Okay, no one predicted COVID and no one predicted these stimulus checks. Well, when it came time for all the stimulus money that was doled out, if you hadn't filed a tax return, it was taking, I don't know if you got, I guess you got the money eventually. I don't really remember all the details, but I have a relative who hadn't made very much money over the past couple of years and hadn't filed a tax return. And he had to file a tax return in order to get the stimulus money. And so we had to go back. I did it for him, and I went back and filed these past tax returns, and it ended up costing like $60 to file these past tax returns. So my point is, you should file a tax return regardless, because if the government is going to give you some kind of credit or stimulus money, it's good to have that on file. So regardless of how much you make, always file a tax return. And then another situation, if you file a tax return, it shows your status, it shows your residency. And so, you've got, for example, if you wanted to go to school if you wanted to go to school in a different state or a state that you're living in, the tax return is a way to prove your residency. So I would recommend filing a tax return. All right, even though you don't have to. Okay, so number 2, the federal income tax withheld depends on both your level of earnings and the number of withholding allowances claimed. That's kind of true. When they wrote this, it was true. But last year they changed the allowances. You used to be able to, have like 0, 1, 2, or 3 allowances, and the more allowances you had, the less they would take out. But last year they changed it, and everyone's got the same withholding as far as the allowances. But it is true, of course, the more you make, the more money that's going to be withheld. You can withhold more if you want. So what happens is, when you file your taxes, if you owe more than a certain amount, it's around, I think it's between $1,000 and $2,000. But at the end of the year, when you file your taxes, if you owe them money, if you owe the IRS more than a certain amount, they're going to assess you a penalty, because they want you to pay throughout the year. Okay, so you can have that penalty waived if you've had, for certain reasons, like if your income has gone up this year, or certain other reasons. So the point that I'm making is, you should look at once you filed your taxes, you shouldn't bank on getting a refund. Because and why would I say that? From a financial planning standpoint, why? Yeah, if you're getting a big refund from the IRS, people will tell me, oh, I'm getting this big refund. I'm getting a $3,000 refund. Well, I'm not going to be rude to them, but that's really stupid, because you've just let the IRS have $3,000 that you could have been investing all year long. And so unless you just can't save any money and you're going to use the IRS as a savings vehicle, you don't want to get a refund. So you want to work it out to where you either you owe them a little bit of money or try to zero it out. I try to figure it out where I owe them $1,000 or less. So what I will do is, when I do my taxes, if I haven't withheld enough, then I'll go to HR, and you can add a certain amount. So like, I'll go to HR and I'll say, well, I need to add an extra $50 per pay period of withholding, or an extra $100 per pay period of withholding. If you're withholding too much, then you can try to reduce it. But I tried to reduce it last year by changing the exemptions, and they weren't allowing that anymore. So anyway, just monitor. The main point regarding the federal tax withheld is, you just want to make sure that you're not going to owe the IRS more than $1,000 or more than $500 if you're single, because you don't want to get hit with this penalty. Okay. Federal taxes are levied against the total amount of money earned. No, federal taxes are levied against your taxable income. So we're going to see in this chapter how we arrive at the taxable income. There's a lot of deductions that we can take before we get to that point. All right. The next one, gains on the sale of investments such as stocks, bonds, and real estate are taxed at the lower capital gains rate. Okay, well, that's only true for long-term capital gains. The long-term capital gains, meaning that means that assets that you've held for at least a year. So stocks, bonds, real estate that you've held for 1 year, you're going to be taxed at this long-term capital gains rate, which is much lower than the short-term rate. If you, which I'm going to show you those rates in a minute, the new rates. If you sell something, if you sell a stock or a bond or a house within a year, it's a short-term capital gain. That's not good because that's taxed at your regular income. So if you're in the 20% tax bracket, you're going to pay 20% on your short-term capital gains. So it really behooves you to, if you can, I mean, if you've got money in a stock and it's gone way up, like Bitcoin, well, if you bought Bitcoin or if you bought, I don't know, AMC, any stock that's gone way up, I wouldn't say, oh, don't sell because because of tax reasons, because if you think it's going to go down, then you certainly should sell. And I'm going to talk later in the chapter about some strategies to mitigate your short-term capital gains or long-term capital gains. But anyway, if you're just a long-term investor, try to hold things for a year, because then you're subject to the long-term capital gains, which are much lower. All right. Tax credits, deductions, and exemptions reduce your taxable income by comparable amounts. Okay, that's not true. So what is the difference between a tax deduction and a tax credit? Brett? Okay, so what would be an example of a deduction? Okay, so medical insurance is reduced deduction, or like home interest on my house. If I contribute to a regular traditional IRA, I can deduct that. Okay, but with a deduction, I've already paid that money, right? Okay, so if I put in $6,000 into a traditional IRA and I deduct that, that's reducing my income by $6,000, but I've paid the $6,000, you see? So I'm only getting, if I'm in the 20% tax bracket, my deduction is going to be, my taxes are going to be reduced by what? 20% of that is what, $240. What, $1,200. So 20% of 6,000 is $1,200. So my tax, I paid out 6,000. I'm reducing my taxes by 1,200, 20% of the 6,000. So if my interest expense, if I have interest on my home, I paid all that interest, but I'm able to deduct it. So if I'm in the 20% tax bracket, I'm able to deduct 20% of it. So the point with the deduction is you've paid that money out. You're just getting a little bit of a break there. Okay. A credit is a dollar for dollar credit. And so in other words, if you have the earned income credit, and we'll talk about this, this child care credit or this earned income credit, if you get a credit, they're paying you money, dollar for dollar, you see. So if you have, let's say you owed $500 on your taxes and you got a $500 credit from the IRS, you're not paying any taxes at all. So a credit is much better than a deduction, because with the deduction, you've already paid out the money. You're just getting a break on part of it. But a credit is money coming to you. They're actually paying you money. It reduces your taxes dollar for dollar. So a credit's better. Okay, and then finally, the last one, an easy way to earn tax deferred income is to invest in Series EE savings bonds or savings bonds. They're all, the basic ones are Series EE. So is that a good way to earn tax deferred income? Well, our savings bonds tax deferred, the interest? They are. I mean, yeah, they are. So yeah, these are government bonds. So yeah, you're not going to pay with a savings bond. You don't pay taxes on the interest until you cash them in. So that is a good way. That is a way to defer money. So if you go buy savings bonds, they're actually zero coupon bonds, these US savings bonds, which means that they don't pay you regular interest payments. A zero coupon bond is discounted, and then you get all the interest at the end. So that's why if you went to the bank today and you went online and you bought $100 savings bond, it would cost you $50. And then when it matured, it would be worth $100 because the interest is all baked in. And then if you kept it longer than its maturity, it's going to continue to earn interest, I think, for about 30 years, and then it converts to a Series HH. You'd have to convert it. But I mean, they don't pay a lot of interest, but if you wanted to have a really safe investment that's tax deferred, you can buy these savings bonds. Now, I think savings bonds are a really good way to help people to invest, to save for college education. Some of you may have savings bonds from when you were kids. I would recommend cashing those in while you're in school, because here's the deal with these savings bonds. If you use the savings bonds for school expenses, you don't have to pay taxes on the interest. So now's the time to cash them in while you're in school, and you won't be taxed at all. And they don't ask you for some item. And when you fill out your taxes, they don't ask you, did you really take this money and what did you spend it on for school? It's just you're a student, you're cashing it in, and it went to expenses. So I would recommend, that's what I did when I was in school, and that's what I had my kids do when they were in school. So because you can make a lot more money in the market, but a lot of what my family does is, like when we have birthdays or Christmas coming up, instead of spending $50 on a toy for my nieces and nephews, I'll spend maybe $25 and get them a $50 savings bond for $25. And then that adds up over the years. This is another thing. When I worked as a financial planner, if you have a bunch of savings bonds lying around, make sure that you take pictures or write down all the serial numbers or take pictures of them, keep it in a lock box and take it with you if there's a hurricane. Because if you lose those savings bonds, it costs quite a bit of money for them to research the ones that you had and all this. I had a client who had to pay like over $500 for them to research the bonds that were lost. So at least it's easy now, just take a picture of them or take them with you.
You had to look it up on microfilm.
They probably did. Yeah, I'm sure they did. But I used to have, when I lived in Slidell, I don't have this anymore, but when I first moved to Louisiana, I've been here a long time. I moved to Louisiana in 1989. So I've had several hurricanes that I've had to evacuate for. I just remember one distinctly, forget the name of it, but I was living in Slidell at the time. It was in the 90s. And I actually had this metal box with stuff. I mean, I'm sure your family does that too. Had a metal box with all this stuff and to take with you in case it gets destroyed. Okay, anyway, that is the facts and fantasies. Okay, before we go any further with PowerPoints, I want to pull up the new tax rates. So let me try to get to that. Okay, so this is on this link on Moodle. You can either these are the 2021 tax brackets, and you can either download a PDF or download the data. Let me just download the data here. And it is in an Excel spreadsheet. It's not coming up. hang on, I had it up earlier, now I can't. Here it is. Okay. Okay, so before you do the homework for chapter 3, download this data because you're going to do the homework using the 2021 tax rates. And so for that homework assignment, the person is single. And so the standard deduction, you're going to figure out, you have to figure out this person's taxable income. And the standard deduction is $12,550 for someone who's single. So that's what you're going to use to figure out their taxable income. Okay, so let's go back to this. So this is, these are the new tax brackets. And so let me see if I can make this a little bit bigger. Okay, so these are the 2021 tax brackets. So if you are single and you make from 0 up to $9,950, you're going to pay 10% tax on that. If you're married filing jointly, you're going to pay 10% tax up to the first 19,900. Let's go back to the single. The way this works is then any money that you've made over $9,950. So from $9,951 to $40,000 as a single person, you're going to pay 12% on that. From $40,000 to $86,000, you're going to pay 22% and so forth. So this is what we mean by a progressive tax system. The more you make, the more you pay. And so you see that people who are making $500,000 or more, the highest bracket, the highest rate is 37%. So when President Trump was in office, he reduced the tax rates. If you look at the old ones prior to 2018, they're about 3 to 4% higher across the board. So these are our new tax rates. So we got about a 4% tax reduction under the Trump administration. The Biden administration has discussed increasing the taxes, increasing the rates, but they're only going to increase the rates on the wealthier people. So they're really concentrating on people making over 200,000. I don't recall exactly, but it's people in the 35 to the 37% bracket. So it shouldn't affect most of us, any of these tax increases by the Biden administration. So these are the rates. So anyway, that's those are the rates for this year. They change, the income levels change every year. So if somebody asks you, what tax bracket are you in? Well, let me ask you this. If you were single and you made $10,000 this year working part-time, what tax bracket are you in? If you're single and you have $10,000 of taxable income, right, you're in the 12%. So the tax bracket is the highest rate that you pay. Okay, so that's your tax bracket or your tax rate. The average tax that you're paying, though, is going to be lower than that, because to calculate your average tax rate, you take your total tax that you paid and you divide by your total income, and so it's going to be, in between, it's going to be an average, it's a weighted average. So your average tax is going to be lower. So like if you use this, when you do your taxes, if you use software, I use TurboTax. I've used TurboTax for probably 20 years, and always on the first page, it'll tell you what your rate is, and it'll also tell you it'll calculate your average tax rate too. Okay, so those are the taxes. These are the deductions, the standard deduction. Okay, we used to have a standard deduction and an exemption. The Trump administration vowed to simplify the tax code, which they did, and reduce taxes. So it used to be you had this standard deduction, or you could itemize, and then you had an exemption. An exemption was for you, your spouse, and any of your kids. So if you had 2 kids, you would actually have you'd have 4 exemptions: you, your spouse, and the 2 kids. They've eliminated the whole exemption thing. They just have this standard deduction. They increased the standard deduction. They basically doubled the standard deduction. So what that means for us, it's good and bad. What they did was by doubling the deduction, most of us can't itemize anymore. So it's really simplified the tax code, because when we do our taxes, we just take the standard deduction. So for most single people are not going to have itemized deductions over this amount. Most married people are not going to have itemized deductions over this amount, so you just take the standard. But for some people who maybe had really high mortgage interest, or who had a lot of deductions, they're they might just be at the cusp of it. Some people might have 21,000 as a married couple, but it's better for them to take the itemized. It's better for them to take the standard. So this has people, people change their behaviors, based on incentives, and it doesn't make a lot of sense now. If you have an old mortgage with where you're paying a rather high interest rate because you didn't refinance, if you can't deduct the mortgage interest anymore because you're using the standard, maybe it makes sense to pay off your mortgage. And so some people are, rethinking some of these strategies because the deduction is so high now. So anyway, this is what you're going to use for the homework, is the $12,550. That's the standard deduction. And then this is married filing jointly. Filing as a head of household. Some people file separately when they're married, or head of household, and that's what that is. But the most common are either single or married filing jointly. Okay, this is the alternative minimum tax exemption. Your wealthier people can be subject to this alternative minimum tax. It's not that common, so I'm going to skip that. You see what you have to have made. You have to have made $500,000 single or over $1 million married to pay this AMT. So that doesn't affect most of us. Okay, here's the earned income credit. So remember, well, we're going to talk about this in the slides, but you may have read this. Basically, half of the people in this country don't pay taxes. So when you hear this rhetoric about how the rich don't pay any taxes, and it's all the taxes are being put on the poor and the middle class, I will tend to agree that the middle class does tend to get screwed over because they don't have all the benefits that the wealthy have, and they don't have all the benefits that the poor have. So I feel like the middle class does pay more than their fair share, but half of the people in this country don't pay taxes. Well, and here's one of the reasons why. Because if you're a typical, if you're married, family of 4, 2 kids, and if you're on the low end of the spectrum, if you're working class or somewhat poor, you get this, you're not going to pay any taxes because you get this credit. In addition to not paying taxes, you're probably getting more money. The IRS is paying you, because remember that credit is money that they're giving you. So if you have, if you're single and let's say you're single with 2 kids, you can get up to $6,000 in this earned income credit. Okay. If you're married, filing jointly, and you're only it's a low income for sure. If you're married filing jointly and you have 2 kids and you're only making $15,000 a year, you could get up to $6,000 in this earned income credit. So anyway, you can see that the phase out for it begins at $25,000, and here for single it's $19,000. But this is a way for low income people to help out low income people by giving them this credit. And this is what's crazy, is a lot of these people who would qualify for this don't file their taxes. They don't know about it. And so so anyway, when you hear that, half of the people in this country don't pay taxes. Well, that's because there's legitimate reasons for that. It's because of these credits and so forth, and because of the progressive tax system that we have. Now, let me throw this out here. Do y'all know who Warren Buffett is? Okay, so Warren Buffett started this mutual fund. He's an investor, very conservative guy. So Warren Buffett, he is for raising taxes. I think he's a Democrat. He did not vote for Trump, and he was for raising taxes, not lowering taxes. And he said, my secretary pays more in taxes than I do. Okay, so I don't think he's paying his secretary as much as he's making, for sure. So what did he mean by that? My secretary pays more in taxes than I do.
Literally does. He has a lot of write-offs.
Okay, well, let me ask you this. For most of us, the lower class, working class, middle class, upper middle class, how are we making our money?
Their income.
Yeah, we're making our money through income. Okay, so when I have some investments, but they're mostly in retirement accounts. So I get a W-2 at the end of the year, like the rest of you, and they withheld taxes. And I just cringe when I see my W-2 and see how much taxes I've paid, because as I've been successful and made more money, I'm paying more money to the IRS. So anyway, you just saw the tax tables, okay? The most wealthy people, the majority of their income is not coming from active income, meaning working and you're getting a W-2. They're getting investment income. They're getting passive income. Passive income is from rental properties and such. And so let's just talk about investment income. So people who are wealthy, Warren Buffett has a lot of investments. The capital gains, the long-term capital gains rate, the lowest rate is changed now. The lowest rate is 15%. The highest rate is 20%. So that's what he meant by my secretary pays more in taxes than I do. She doesn't pay more in taxes, but her tax rate is higher because let's just say he's been paying her really well. She might be in the 32% tax bracket, whereas Warren Buffett is in the 20% tax bracket because it's all capital gains with him. And he's got write-offs too with passive income. So the point there is the point that I'm making there is wealthier people pay the majority of the taxes. But when you hear these people on the news that are trying to put a spin that wealthy people don't pay taxes, the spin that they're putting on that is not in real dollars, but it's in the actual rate. It's the tax rate that's lower. So anyway, that's what they're getting at with that. Okay, here's the capital gains. So this was reduced. In fact, if you're in the investments class, on Monday, I mentioned that the lowest tax rate capital gains was 10%. Well, that's old news. That's not true anymore. These are the new capital gains rates since I think in 2018 is when all the rules changed after Trump was elected. So this is the way this works. If you're single and your taxable income is between $0 and $40,400, you're not going to pay any taxes on your long-term capital gains. That's awesome. You can trade in you can make all the money you want in your Robinhood account, your Fidelity, Schwab, trade and sell and buy all you want. You're not going to be, this is long-term capital gains now. The short-term capital gains are subject to, you're going to pay taxes at your regular tax rate. But this is even more incentive to buy and hold for at least a year, because if you sell within a year, you're going to pay taxes on it. If you wait a year, you're not going to pay any money up to $40,000 in taxable income, up to $80,000 if you're married in taxable income. So this is your income after all the deductions. So 15% from 40,000 to 445,000 here, from 80,000 to 501,000 if you're married filing jointly. So most of us are, most people are probably, I would venture to say that most people who are making from 0 to 40 or from 0 to 80 taxable income, they may not have a lot of money to invest in the markets. It's probably not really an issue for them. But the majority of us are going to fall in this category. So you're looking at a 15%, you're paying 15% on your long-term capital gains. So if you sell stocks or bonds after a year, you're going to pay 15% on that. So that's not too bad. Now, the Biden administration says that they're going to increase the capital gains tax. And the market, this was like about a year ago, they talked, he mentioned more about it, more specifics about it, and the market sold off like 600 points in a day. Well, I knew it was a buying opportunity. So I actually bought some stocks on that day, because here's the deal. He's going to increase the capital gains tax for people with capital gains of 1 million or more. $1 million or more. Okay, not people making $1 million or more. You actually have to have capital gains of $1 million or more. That's what he said. Nothing is definite yet. So that's going to affect so few people. It's like less than 2% of American citizens. So that's not really an issue for us. So anyway, that's the long-term capital gains. Those are the brackets there, just so you know. It's easy to remember. Basically 15 or 20%, pretty much everyone's going to be paying 15% on long-term capital gains. Okay, and that's business income. We're not going to worry about that one. Okay, any questions or comments on the tax information? So if you look back in history, these rates are pretty low. In the 70s and the 80s, we had our taxable income. The tax brackets were much higher. They have gradually gone down over the years, which is a good thing. All right, so let me get out of this and try to get back to the slides. All right. Okay, so here, this last line is kind of interesting. Well, all of this is interesting. The typical American family pays more than 1/3 of its gross income in taxes. So we've just been talking about federal tax right now. You've also got state tax. They're including all taxes: state tax, property tax, state income tax, property taxes, sales tax, Social Security taxes, Medicare tax. Okay, this is what's really ridiculous, in my opinion. The second line here, Social Security tax. Okay, between Social Security tax and Medicare tax, we're paying 7.65%. Okay, it's 6.2 in Social Security and then 1.45 in Medicare. So think about that. 7.65% of your check, or just forget about the Medicare. Let's just talk about Social Security. What if you could save 6.2% of your paycheck and invest it? I would guarantee you would have much more than you're going to get in Social Security. That's it's unfortunate, I think, but that's just the way it is. So it's depressing when you forget your first job and see how little you're making after all these taxes. So, and that's just the half of it, because your employer has to match that. So your employer is paying another 67.65%. So for every dollar that you make, up to 100 and it's about 130,000, because after 130 some thousand, they don't take any Social Security out. But for every dollar that we make, 15.3% is going to Uncle Sam, just on Social Security and Medicare. So that's crazy. I think it's unfortunate that we're paying all that out. Okay, and then also taxpayers who make over 250,000 filed 2.4% of the tax returns, and they paid almost half the taxes there. So that's another half. You know, half of the people don't pay taxes, but the 2.4% of Americans are paying almost half of the taxes, and so the wealthier, even though their rates are lower, they are paying the bulk of the taxes. All right. Okay, just ignore these tax rates because these are the old ones. So this is a new addition. So they are reflecting the Trump tax deductions, but you see every year they increase the base pay through inflation. Oh, let me go back and mention something about Social Security though. For those people who are collecting Social Security, I'm sure you all have grandparents who are collecting Social Security. The Social Security checks or the benefits are subject to COLA, the cost of living index. Well, with our, you know, we've got a little bit of inflation going on since COVID. I actually read they're talking about a 6% raise in Social Security for people. It's been a while since they've gotten an increase, but they're talking about increasing the Social Security benefits in January by 6%. But you know what they do every time they give a raise to the Social Security beneficiaries? Then they increase the Medicare deduction, the deductible rather. They increase the Medicare deductible, so it all kind of washes out. All right, there's the tax rate. Okay, so we have a progressive tax rate. Oh, hang on, I'm gonna go back here one more. I wanted to talk about this a little bit more. All the taxes that we pay. Let's talk about some of these taxes. Oops, that's not right here. So there's some states that have no income tax. Does anybody know what those states are? There's a few states near us that have no state income tax. Texas is one of them. Florida is another one. Okay. So a lot of people from this area move to Texas and they think, oh, this is great. I move into a state with no income tax. Awesome. Then they buy a house and they have sticker shock at the end of the year because why, Wendy? The property taxes are really high. So what you're saving, and it's like, you know, robbing Peter to pay Paul, what you're saving in income tax, you're paying in the property taxes. Now they do have really good schools in Texas. And so, you know, if you're in,
Good roads.
and good roads, yeah, good roads. I was in Mexico over the summer, and we had company come out a few weeks ago, and we took them to New Orleans. The roads in New Orleans, it's worse than any third world country I've ever been to. It's ridiculous. I mean, you guys know from being there, it's worse. And after each storm, it gets worse and worse. So, yeah, you do.
I remember it's like 3 years ago. It's not really a road, it's just like gravel.
Yeah.
Gravel, just like a little rubble thing.
Yeah. Right. It's terrible. So anyway, the point I'm making is we have over in Louisiana, we have a $75,000 homestead exemption. That means that you don't have to pay any property taxes on the first $75,000 value of your house. I'm all for reducing that but it's a sacred cow. It's not politically correct for anybody up in Baton Rouge to say they want to reduce that homestead exemption. But just think about that. All of these people who have and they have, the assessors are behind in assessing the values of these homes. And so if your home is worth, 75,000 or less, you're not paying any property taxes at all. Well, that all translates down to our schools, lack of funding for our schools, lack of funding for the roads, it all. And if without infrastructure, we can't bring in, businesses. And so there, there's good and bad with everything. It's nice to not have to pay a lot of taxes, but then you don't have the services also. So anyway, okay, so we talked about the property, the state income tax. Florida doesn't have any state income tax, and they don't have really outlandish property taxes either. So I find that kind of interesting. And then of course, sales tax. Sales tax is high in most states, and sales tax is considered a regressive tax. And let me go back. Let me go to this slide now. Okay, so let's talk about progressive versus a regressive. So our federal income tax system is considered to be a progressive tax system. That just means the more income you make, the higher bracket you're going to be in. So the more you make, the more you're going to pay, as opposed to a flat tax. So some countries have a flat tax. In Europe, in Great Britain, you pay a 50% tax rate, flat 50%. Well, that's seen as being regressive. And so why do you think that? I mean, that seems fair, right? If everyone's paying the same amount, the same percentage, but why is that viewed by politicians and economists as being as basically penalizing or being unfair towards lower income people?
You only make like $20,000 a year.
Exactly. Yeah. Right. If you're married, you've got two, professionals. Let's say they're making $150,000 a year. They're taking home $75,000. If you're a single parent making $25,000 a year, you're taking home $12,500. So it does really penalize you. And so they're using the example here of a sales tax as being regressive. And so that's true. Like sales tax is regressive because everybody has to buy food. Everyone has to buy things. And if that's higher, it's going to disproportionately affect poorer people. So I just remember comparing California to Louisiana when I moved out here. And so everybody said, oh, well, you got the $75,000 exemption. Your taxes are going to go way down. But this is what they don't tell you. This is the problem. So let me share this example with you. This was back in the 80s. I had a house in California that was worth I think we paid like $107,000 for this house. So I owned this house in California. It was $107,000. Okay. I paid like $1,100 I think I paid $1,100 or $1,200 in taxes. So moved to Louisiana and I find out about the $75,000 exemption. I'm all excited that I'm going to save on my taxes. We buy a house in Louisiana for $118,500. I remember that because it was the first house we bought here, $118,500. And so I'm thinking, I'm going to save all this money in taxes. I get the tax bill. It's $1,150. It's the same I was paying in California. California has a $7,500 homestead exemption. Louisiana has a $75,000. So I'm looking at the tax bills. So here's the deal. Once you get above that $75,000 mark, the rates are so high that it really doesn't help us at all. So anyway, that's what you think is a good deal is not really a good deal. Then this is the main thing that I found that was so unfair to us as Louisiana residents. At that time in California, sales tax was only like 6%. It's more now. But I moved here and California didn't charge tax on food. A lot of states don't charge tax on food or medicine. So I moved to Louisiana. They're charging tax on food. It's at a lower rate, but you're paying tax on food. You're paying tax on medicine for pharmaceuticals, prescriptions. And so anyway, my point is, Louisiana does have a lower income tax rate, but it really penalizes people in lower income brackets when you're having to pay tax on food and tax on groceries, if groceries, tax on medicine and so forth. So anyway, it is a good idea if you're moving to another state, to just Google and look at the sales tax, look at the property taxes, look at just see what the cost of living is there. To me, higher property taxes are better because it means the schools are going to be better. So that's a direct correlation with that. Okay, but anyway, make sure you know the difference between a progressive tax rate and a regressive tax rate. This is how you calculate the progressive tax system and a regressive tax system. This is how you calculate the average tax rate. Your marginal rate is the highest that you're paying on the last dollar earned. The average rate is just your total tax divided by the taxable income. All right, we talked about that. Okay, so there's your gross pay and then there's your take-home pay. So I'm going to jump to this slide here. This is how you figure out your tax liability. Okay, so you have your gross pay, your gross income. So if you look at your W-2 at the end of the year, it'll tell you what it'll give you your taxable income. So that's all of your income subject to taxes. Then you take out your deductions. So you've got your taxable income, you've got your gross income, and then you take out all of your deductions. Any contributions you've made to retirement plans, anything that's tax deductible off of your gross income. And it's normally retirement plans, or if you've contributed, if you're paying for through your work, if you're paying for retirement plan contributions, if you're paying for some of your medical expenses, insurance, medical insurance, an HSA plan, whatever. Yes.
On a Roth IRA, if you doing that with pre-tax money, is that pre-tax money off of your normal income tax bracket?
You don't get a tax break at all.
No. I mean, when you use it, it's after you get paid, correct?
Right.
It would be off of whatever tax bracket you would be in. That's what your pre-tax would be, right? So then you put it into a Roth IRA, and then what does it return? 7 to 10%, somewhere in that range. Like the interest on it.
Well,
I'm
Roth.
wondering what the difference would be if you go ahead and you do a traditional IRA versus a Roth IRA, because if you do a Roth is pre-tax. If you do the traditional, it's not tax.
Right.
So I was wondering off of the longevity of it, if you go to regular traditional, if you take your money out after 59, which is going to be your tax rate then when you take that out, versus what you're going to do with the tax money going in and what you're going to earn.
Right.
The compound.
Right.
I guess you have to try to figure that out.
Well, yeah. Well, think of it this way. Let's say that you're, if you're in the 20% tax bracket, then you would have to make 8%. You'd have to make 10% on a Roth versus 8% on a deductible one, because you can make because that's basically the 20% difference. You see what I'm saying? And just off the top of my head. So, but I would go with a Roth, because here's the deal. We're going to have higher taxes in our future. Okay. And also, if you've done the Dr. Lawrence system of being a millionaire, I mean, it's easy for your Roth IRA or any of your IRA accounts to be $1 million when you're 70, easily. Probably when you're 60, you'll have $1 million. So you're not going to be in a lower tax bracket, probably. Because if you've got this Roth and if you've got your regular retirement accounts and you've invested in real estate, the chances of you being in, if you've been successful, the chances of you being in a lower tax bracket when you retire it's probably not going to happen. Now, if you're 40 or 50, like at my age, I probably will be in a lower tax bracket when I retire because I'm closer to retiring. But if you're trying to look out 40 some years, you're probably not going to be in a lower tax bracket. Number one, you're going to have all these investments. And number two, taxes are going up. And so you're just better off having this Roth IRA, because with the Roth IRA, you're not getting any tax deduction. If you put $6,000 into a Roth or $1,000 into a Roth this year, that's just after-tax money, just like you went out and spent the money. No tax break at all. But you're never paying taxes on that money. When you withdraw it, you're never going to pay taxes on any of the interest or any of the dividends or anything, any of the capital gains, nothing. And so like I'll have a Roth, like for example, my daughter has a Roth. And so what a lot of people get confused about with a Roth IRA is they think that, okay, I'm going to open this Roth IRA account and it's like a savings bond. It's earning a specific amount of interest. That's not true at all. Just like you opened up a brokerage account, say at Robinhood, I don't think Robinhood allows IRAs. So let's use Schwab. Just like you opened up a brokerage account at Schwab, say, you can open up a Roth IRA at Schwab. It's just the way the account is coded. It'll say Roth IRA. You can invest in whatever you want. You can buy Bitcoin if you want. You can buy stocks, bonds, anything. You can't go out on margin or short sell typically, but you can buy and hold and invest. And so this is another really interesting thing that a financial planner said to me years ago. I was teaching at UNO and I had him come in as a guest speaker, which I never really thought of. And he was saying, shouldn't your riskiest investments be in your Roth IRA? Because you're not going to pay taxes on any of those gains. So if you want to try to speculate with some small cap stocks, do it in your retirement plan, where most people think, oh, that's got to be really safe. But if you're young, it really doesn't matter. So my point is, you should go with the Roth because there's no taxes on it at all. With a traditional IRA, you get the tax deduction. So we're coming back to this. If you put $1,000 into a traditional IRA, you get that tax break right here. But then when you withdraw the money years later, you're going to pay taxes on it. So because the taxes are so uncertain, it's better to have the Roth. And this is the final reason, and I think really the most important reason to get a Roth, in addition to the tax-free aspect of it, is that you can take the dollars out whenever you want to with no penalty. So it's not like you're never going to see that money again if you need it. So let's say you contribute to a Roth and then you graduate and you need the money. You want to put down payment on a car, or you want to buy a house. You can take the contributions out at any time because you never got a tax deduction. Since you contributed with after-tax dollars, the IRS will let you take those contributions out whenever you want. And so my daughter's actually, we've taken distributions from my daughter about 5 times back and forth, over the years when things have happened. So just think of it, that's your emergency savings right there. I mean, I don't recommend doing that because you're foregoing future interest, of course, or future earnings, but it's there for you if you need it to take advantage of that. So anyway, you can take the contributions out at any time. The earnings have to be in there for at least 5 years. And then after that, you can take the earnings out for certain reasons. First-time home buyer up to $10,000, medical expenses, education expenses, or a threat of bankruptcy. So, okay, so getting back to this then, here's our gross income, and you take out your you subtract any of your tax deductions for retirement plans. Typically it's retirement plans or it's healthcare and so forth that you've paid through your employer or a regular IRA. Then you have your adjusted gross income. Okay. So you've got your adjusted gross income here. Then you take out that standard deduction. So if you're single, This is where you're going to subtract the $12,550. If you're married, it's 25,000. Or if you're itemizing, if it's more than that, you'd have all these itemized deductions. Okay, then the personal exemptions would come out. Those are suspended until 2025. So we'll see what happens with that. There's no more tax. So right now we just have the standard deduction, no exemptions. Then you have your taxable income. So that's how you get from your gross income to your taxable income. Then you might have some tax credits. So here's then you subtract out any credits. So let's say somebody has taxable income of $3,000 after all this, and they've got a tax credit coming in of $5,900. They're making money with these credits. All right. So anyway, most of us don't have these credits. So here's our taxable income. Then you go to the chart, or the software will tell you what the taxes are. And then you have the tax liability right here. So that's how you figure out your taxes. It's real simple. So if you guys don't do your own taxes, I would highly recommend doing your own taxes, because for most of us, it's not that complicated. The software makes it so easy. Like I said, I've been using TurboTax for years, and e-filing. And also you can, if you get audited, they'll help you. The TurboTax people will help you. And so anyway, it's just, they kind of walk you through it. My opinion on using a tax preparer is I have to go through all the legwork to get all the information to them anyway. I might as well do my own taxes. So unless you have a real complicated situation, it's with the technology today, it's easy to do your own taxes. All right, let me wrap this up here. Okay, I want to talk quickly about the capital gains. And then I think that in the passive income, okay. I can if I don't have enough time, I can catch up on Monday. But anyway, let's talk about the capital gains. All right, so we already saw the capital gains from the tax bracket, from the tax rate. So in the chart, they were giving us actual income numbers. Here they're talking about percentages. But so just remember, I think it was what, $9,950. Or it was up to 40,000, from 0 to 40,000. If you're single, you don't pay any capital gains tax long-term. From 0 to 80,000 if you're married. And then so most of us are going to pay the 15. So the capital gains is either 0, 15, or 20. Short-term capital gains is stock or real estate you've held less than 12 months. That's going to be taxed at your regular tax bracket. Okay, so what if you're in the 15% bracket here? Or what if you're, well, let's talk about short-term and long-term. So what if you have this Robinhood account and you've made some money? You made some money in some stocks. And so you look at it's approaching the end of the year, and you look at your Robinhood account and you've got some short-term capital gains. You've got some short-term capital gains. Let's say you've made $1,000. Okay. Well, you don't want to pay 150 of that. 15% of $1,000 is $150. You don't want to pay $150 to the IRS. I'm going to show you a way to not have to pay any capital gains at all. And this is how. Probably you have some stocks that you're losing money on. So go through your account, and any stocks that you have that are down, sell them. And so you can take short-term capital losses to offset your capital gain. So try, if you have $1,000 that you could take in capital losses, sell everything to give yourself $1,000 in capital losses, then you won't pay any income taxes at all. Now, if you want to take that further, if you want to sell, you can take up to $3,000 in capital losses a year on your taxes. And so you could even sell more if you had more losses and take it. So, and this is how you get around the situation. You know, if a stock has gone down, you might be saying, well, I don't want to sell that stock because I think it's going back up. They don't let you sell a stock and buy it back for 30 days. It's a wash rule. So in other words, if I sold a stock, took the loss and then bought it back the next day, it's going to negate the capital loss. But this is what I'll do. Let's say I'm way down in ExxonMobil. I'll sell ExxonMobil to take the loss to minimize my taxes. Then I'll just go buy Chevron, or I'll buy a competitor because I think it's going back up, and I'll just get in something else, or I can buy an ETF or something. So that's a way to mitigate your tax situation with your with the short-term capital gains. And of course, you can do the same thing with long-term capital gains. If you have some long-term capital gains, sell some of your losers to offset that. Okay, dividends used to be taxed the same as interest, but dividends are taxed at the long-term capital gains rate now. So we're getting a break on our dividend income as well. And then this is just showing you how you can take up to $3,000 a year in capital losses. So a lot of people lost a lot of money in 2007 to 2009. There's people out there with tens of thousands of dollars in losses from that period. And they can only deduct $3,000 a year. Well, you can use those losses to offset any future gains. And then in addition to that, deduct $3,000. So, and there's no time limit on that. So they're saying here that, let's say you had $50,000 in capital losses. It would take you 17 years to deduct, to just get the $3,000 deduction per year that they have. Okay, and then I think this is the final thing I want to talk about. The three types of income: active income, portfolio income, and passive income. So active income, that's income from work, W-2 income. Okay, that's what most of us have. Portfolio income, that's investment income. So investment income is going to be taxed at a lower rate, at the capital gains rate. And so that's what I was talking about earlier. Warren Buffett versus his secretary. She has active income, he has investment income. He probably also has passive income. Passive income is income from like rental property. So if you have, let's say you have rental income coming in, that's called passive income. You can use all of your rental expenses to offset the rental income. So let's say that you don't have enough deductions to itemize when you do your taxes. But if you have a rental property, the mortgage interest on that rental property, all of the fees, all the expenses associated with that rental property, you can use that to offset the rent. So that's what they call passive income. So that's why people, wealthier people have more of these two categories, passive income and portfolio income, and it's taxed at a much lower rate than the active income. Okay, well, I want to talk about a few more things, but we can continue this on Monday. All right, so have a good rest of the week, and this chapter 2 is going to be due on Monday. We'll finish up chapter 3 and go over chapter 4 on Monday. Do any of you have any questions on Zoom?
No, ma'am.
Okay, could you hear me all right through the whole thing?
Yes.
Okay, good. All right, well, I'll see you. I'll load this. If you want to see this again, it's going to be loaded on Zoom or on Moodle rather. And I'll see you all in class on Monday.
Okay.
Okay, have a good weekend, everybody. Hey, what's up?